Hello everyone, welcome to this edition of our Fund Insight series where we interact with our fund managers to understand their investment strategies and philosophies for the funds they are managing. I am Sonal Mittal, Product Specialist, and today we have with us Kamal Gada, Fund Manager of UTI Healthcare Fund, to share his insights on this one. So Kamal, can you throw some light on the investment strategy for UTI Healthcare Fund?
Thank you, Sonal, for having me here. UTI Healthcare Fund primarily focuses on investing in the companies engaged in pharma and healthcare space, as well as allied companies where revenues are mainly driven by pharma healthcare sector. The fund is market cap agnostic and invest in companies on a bottom-up basis with the potential to long-term growth. The allocation to a particular company would be primarily driven by the growth profile, management caliber, and the balance sheet strength. We also tactically invest in turnaround and cyclical opportunities for potentially outsized returns. Our investment philosophy revolves around UTI's score alpha model. We prioritize investments in top tier R1 companies with a proven track record of consistent growth and strong return ratios.
Kamal, how do you assess the current state of healthcare industry considering factors such as government policies, infrastructure and demographic trends? Are there any subsectors or trends within healthcare that you find particularly promising or challenging?
That's an interesting question, Sonal, and that's where the healthcare sector opportunity lies. The healthcare sector is uniquely placed to capture both domestic consumption theme as well as exports opportunity, both of which have a decent runway of growth. As far as domestic growth is concerned, rising income levels, increased affordability, increasing insurance penetration levels, and government efforts to make healthcare inclusive gives us comfort for the long-term domestic growth potential. On the exports front, better operating history as well as tailwinds from the supply chain diversification from China should help these businesses going forward. Given the growth potential, we find domestic branded businesses and CDMO companies promising from a medium to long-term perspective. And as far as services are concerned, we prefer diagnostics over hospitals given the valuations, comfort, as well as potential of unorganized to organized shift.
How is your portfolio split between traditional pharma businesses, including generic exports, API, CDMO, and health services? How has this changed over the last year?
Yes, the healthcare sector offers potential to participate in both domestic as well as exports theme. If I were to look at market size, domestic pharma is around $31 to $32 billion of market, diagnostics around 10 to 11 billion, delivery around $70 odd billion, CDMO is around $200 billion. Other theme is margin improvement can continue, generic pricing scenario is conducive, as well as stronger balance sheet should lead to better shareholder payouts as well as exploring inorganic opportunities. The healthcare sector funds also holds potential to better understand and assess the heterogeneous business models in this sector. And as far as UTI Healthcare Fund is concerned, we would remain true to the theme, bottom-up approach, and adopt UTI's core alpha approach, where we prioritize investments with higher ROC profile and better cash generation.
Thank you for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.